Hi, Denise Naylor here, and welcome to my video series, House Purchase Loans Buy Your Own Home, Part 4, Peer-to-Peer Funding. Whatever your experience or opinion about the 2007-2008 banking crisis, would you agree with me that many people have lost a lot of trust in the banks in recent years? When Western governments stepped in to save the banks from losses from 2008 onwards, interest rates were lowered for borrowers to help those in trouble meet their debt payments. Once the banks started receiving less interest, they reacted by lowering savings rates to depositors so that they could preserve profit margins. Fair enough, the banks have shareholders to report to. Today we've had 8 or 9 years of low interest rates, and savers are now struggling to make any real returns on cash saved. Maybe it's currently getting harder for you to borrow cash to buy your house, and your savings are not growing either. Caught between these two forces, some people are deciding to bypass the banks altogether and source cash direct from individuals. The overarching term for this is peer-to-peer finance, or P2P. The Peer-to-Peer Association defines P2P as funding by direct contracts between lenders and borrowers. What do I mean? Well, P2P can be one individual to another known individual directly. For example, your family members may be able to lend you cash. Or finance may be available to you through a collective P2P. Crowdfunding is such an example. Here, individuals lend to a fund, and the fund makes the loan to the individual borrower. Remember the Friendly Society model I talked about in part 1 of this video series? You could think of P2P as your personal friendly society. Friendly societies started out as very local activities to help people known to each other, perhaps through place of work or living in the same district. P2P likewise is a much more personal contract for funding that can be responsive to your individual needs for cash. A downside of P2P is it's considered more risky than other forms of housing finance I've covered in this series. And consequently, lenders expect to receive a higher rate of interest from the borrower. Borrowers respond by generally taking P2P funding for short periods of time. Contracts can be for just a few months. This is in contrast to the standard building society or bank mortgage that lasts for anywhere between 15 and 30 years. The advantage is that your agreement can include more flexibility with P2P than with a standard bank or building society mortgage. So how do you buy your own home using peer-to-peer lending? You start by defining what you need funds for. You might use P2P for a deposit to buy your own home, and then borrow the bulk of your cost from a building society or bank. You might use P2P for bridging, a time period when for some reason you cannot borrow from a building society or bank, and you don't want to miss out on a great deal. Then you look for someone or a group that may be willing to lend peer-to-peer. You make your business case, and you approach them. Every contract is individual. There's no standard approach, and it may take you some time to track down the person willing and able to lend to you for your particular project. Property networking events are a good place to start. You may get rejections at the beginning, but keep going. If the property deal is a good one, you will find someone to finance it for you. More information at www.p2pfa.info. So if you are looking to finance a property development, a building renovation, or for whatever reason your needs don't fit easily into the standard mortgage criteria, you might want to take a look at peer-to-peer funding. Thanks for listening. I hope these videos have helped you with some ideas for your own home purchase. And do join me again.